Disclaimer.
AG here, and look, I've been called a lot of things for my market calls over the years, but early is probably the nicest one. Today, though, being early on silver might actually cost you more than being late. And yeah, I realize how backwards that sounds for a guy who gets paid to see these things coming. Let me show you why the next 4 months matter more than the last 40 years. Silver just crossed $72 an ounce to open 2026, and if you're watching the financial headlines, you might think the story is over. The metal hit multi-decade highs, everyone's celebrating record prices, and the narrative seems pretty straightforward. Silver had its run, time to move on. But here's what should actually grab your attention right now. And while silver was climbing to those headline numbers, something far more significant was happening underneath the surface. The gold-silver ratio, which tells us how many ounces of silver it takes to buy 1 ounce of gold, just compressed from 104 to 1 back in April 2025, down to somewhere between 55 and 64 to 1 today. Think about what that really means for a second. Silver did not just finish catching up to gold's massive run over the past 2 years, it barely started. Throughout history, when precious metals enter serious bull market phases, this ratio typically compresses all the way down to the 15 to 50 to 1 range. We're not even close to that yet, and most investors are walking away thinking they missed the move. The timing of what is coming next makes this even more critical for anyone holding dollars or traditional investments. In exactly 4 months, Jerome Powell steps down as Federal Reserve Chair in May 2026, and President Trump has made his demands crystal clear. He wants the next chair to cut our interest rates down to 1%, calling the current 3.5 to 3.75% range too restrictive, despite our economy growing at 4.3%. According to betting markets tracking Federal Reserve appointments, Kevin Hassett is the frontrunner at 58% odds to take over, but here's the impossible situation waiting for whoever gets that job. Our new Fed chair will inherit a divided Federal Reserve Board face, a Supreme Court ruling on tariffs expected in the first quarter of this year, and deal with relentless pressure to slash rates, even though inflation is still running at 2.7%. This is not speculation about what might happen. The president has publicly stated that rate cuts are his litmus test for the next chair. What do you think happens to the dollar when our central bank gets forced to choose between presidential demands for 1% rates and an inflation reality that is nowhere near under control? Here's where most Americans are getting caught off guard right now. While everyone's focused on whether silver at $72 is expensive, physical dealers across our country can't actually source the metal at anything close to spot price. According to multiple dealer reports from late 2025 and early 2026, premiums on physical silver have widened out to 15 to 25% above the spot price you see quoted on financial websites. Under normal market conditions, those premiums run about 3 to 8%. Let me put that in perspective for you. When you're trying to buy actual silver coins or bars right now, you're paying an extra $10 to $15 per ounce just to take possession, because there simply isn't enough physical metal available to meet demand. The analysts watching this market closely are forecasting silver prices between $100 and $150 by the end of 2026, with gold targets reaching $5,000 to $5,500. But those projections assume you can still buy silver at something resembling current prices over the next few months. What happens when that window closes completely? The physical shortage we're seeing in January 2026 is not getting better, it's accelerating. And once velocity hits this market, trying to enter at affordable prices becomes mathematically impossible. Think about your own financial situation for a moment. Have you noticed how our dollar's purchasing power keeps eroding despite the Federal Reserve claiming they have got inflation under control? Your retirement accounts might show decent numbers on paper, but what are those dollars actually going to buy you 5 or 10 years from now when our central bank is being pressured to run rates at 1% while prices keep climbing? The smart money isn't waiting around to find out. What most people don't realize is that we're sitting in an incredibly narrow positioning window right now. Silver opened 2026 at prices that look high compared to the past decade, but compared to where this market is mathematically headed. Based on supply-demand fundamentals and the Fed chair transition coming in May, we're still at the early stages. Every major bull market in precious metals throughout history has been driven by one core dynamic, currency debasement, and we are about to enter a phase where our central bank faces impossible choices that lead straight to more money printing and lower rates regardless of inflation. The question you need to ask yourself isn't whether silver at $72 seems expensive today. The question is, what happens to any hard asset priced in dollars when our new Fed chair takes over in 4 months under direct presidential pressure to slash rates by 250 basis points or more while our economy is already running hot? According to Treasury market data, investors are already positioning for this scenario. Real yields are compressing. The dollar index is showing weakness, and institutional money is flowing into inflation hedges at the fastest pace we've seen since 2020. Here's what keeps me up at night about this situation. We've got 4 months until the Fed chair transition, a Supreme Court tariff ruling that could invalidate over $130 billion in duties and tank our currency, and a physical silver market where dealers are already struggling to source metal at current prices. The analyst community is telling anyone who will listen that silver has room to run another 40 to 110% from here. And they're basing those projections on conservative assumptions about how high the gold-silver ratio can compress during a normal bull phase. But what we're looking at isn't normal. Pop quiz. What happens when paper contracts for silver traded in London and New York are all claiming ownership of the same shrinking pool of physical metal, and suddenly everyone decides they want delivery instead of just rolling their positions forward? You don't have to imagine. We almost found out in October 2025 when lease rates spiked and the system needed an emergency airlift of metal just to keep functioning. That was just a warning shot. The real squeeze hasn't even started yet, and January 2026 might be the last time regular Americans can position themselves at anything close to reasonable prices before this market enters its velocity phase. The $72 silver price everyone's talking about isn't the end of this story. Based on where the gold-silver ratio is right now compared to its historical bull market ranges, based on the Fed chair transition coming in 4 months, and based on physical premiums that are already screaming shortage, we're looking at the setup phase of something much bigger. The question is not whether silver keeps climbing from here. The math and the fundamentals make that almost inevitable over the next 6 to 12 months. The question is whether you're going to position yourself during this narrow window in early 2026, or whether you're going to wait until premiums hit 50 to 100% above spot and wonder why nobody warned you about what was coming. Now let me show you exactly why this isn't just another bullish metals call that sounds good in theory but falls apart when you dig into the actual numbers. What happened in London last October should have been front page news across every financial publication in our country, but somehow it got buried under election coverage and holiday shopping stories. The London Bullion Market Association, which is basically the central hub for global silver trading, needed an emergency airlift of 53.88 million ounces from New York and Shanghai vaults when lease rates suddenly spiked above 5%. Think about what that really tells us about the state of this market. The LBMA oversees a system where roughly 700 million ounces of silver trade every single day as paper contracts, with billions in standing claims against what's supposedly a stable physical float. According to their November 2025 vault reports, they're sitting on 27,187 tons of silver, which looks reassuring until you realize that number represents the entire physical backing for a derivatives market that's levered something like 100 to 1. When lease rates spike above 5%, that's the market screaming that physical metal is scarce, and people who actually need to deliver are getting desperate enough to pay those rates to borrow what they need. Here's what keeps institutional traders awake at night about this situation. That October emergency was not triggered by some massive geopolitical crisis or economic meltdown. It was just regular market stress from increased delivery demands. The system needed 54 million ounces airlifted across continents just to keep functioning during what was basically a normal month. Now imagine what happens when we hit the Fed chair transition in May with Trump demanding 1% rates, or when the Supreme Court drops their tariff ruling and potentially invalidates $130 billion in duties. Those aren't minor market tremors. Those are potential earthquakes for the dollar and everything priced in dollars. Let's talk about the supply-demand fundamentals that nobody wants to acknowledge because they're so wildly out of balance. According to the Silver Institute's latest production data, global mining output is running at approximately 835 million ounces annually, while total consumption has reached 1.2 billion ounces per year. You don't need an economics degree to see the problem with those numbers. We're consuming about 365 million more ounces every single year than miners are pulling out of the ground. That deficit has been building for half a decade now, and it's not getting better. What changed dramatically in 2025 was the acceleration in industrial demand that caught even the bullish forecasters completely off guard. ETF inflows alone hit 200 million ounces last year, which was triple what analysts had projected at the beginning of 2025. But here's what was really driving this deficit into unsustainable territory. Solar panel manufacturing and electric vehicle production pushed industrial fabrication past 700 million ounces for the first time in history, according to the Silver Institute's industrial demand tracking. Every major solar manufacturer is locked into multi-year expansion plans that require significantly more silver per panel than previous generations of technology. And there's no substitute material that works as efficiently for their current production processes. The mining industry can't respond to these dynamics the way textbook economics says it should. Even with silver trading above $80, even with profit margins that should incentivize massive new production, the reality is that bringing new silver mines online takes between 5 and 10 years minimum from exploration to first pour. According to S&P Global Market Intelligence mining data, There simply aren't enough shovel-ready projects in the pipeline to close this 365 million ounce annual deficit within this decade. Most primary silver deposits are already being mined, and the majority of new silver supply comes as a byproduct of copper, lead, and zinc operations, which means silver prices alone don't determine production decisions. Now layer the political reality over these fundamentals, and you'll see why the next 4 months create such a unique setup. President Trump hasn't been subtle about what he expects from the next Federal Reserve chair. According to multiple public statements throughout late 2025 and early 2026, he's called our current 3.5 to 3.75% interest rate range too restrictive and specifically stated that rate cuts are his all-litmus test for whoever takes over from Jerome Powell in May. Kevin Hassett, who's leading the betting markets at 58% odds to get the nomination, would be walking into an impossible situation on day one. Here's the bind our new Fed chair will face, and this is where you need to understand how this connects directly to your investments and purchasing power. Our economy is currently growing at 4.3% GDP, which under normal circumstances would suggest we don't need emergency stimulus or aggressive rate cuts. But inflation is still running at 2.7%, despite 2 years of supposedly tight monetary policy, and now we've got a president demanding that rates drop to 1%. What do you think happens to the dollar when our central bank is forced to choose between fighting inflation and satisfying presidential demands for easy money? The bond market is already pricing in this scenario according to Treasury yield curve data from late 2025. Real yields, which measure what you actually earn after inflation, have been compressing steadily as investors anticipate the Fed will have no choice but to ease regardless of what inflation does. Every time real yields compress and the dollar weakens, hard assets like precious metals become more attractive because they can't be printed or devalued by central bank policy decisions. We saw this exact dynamic play out in 2020 through 2022 when emergency pandemic policies sent gold and silver soaring, and we're about to see it again. Except this time, the squeeze is coming from political pressure rather than economic crisis. Let me connect these pieces together so you can see the full picture of what's building. We've got a physical silver market that needed emergency airlifts just to function during normal October trading, running a 365 million ounce annual deficit with no ability to increase supply for the next 5 to 10 years. We've got industrial demand accelerating beyond anyone's projections because solar and EV manufacturers have no substitute materials for their production processes. And we've got a Fed chair transition in 4 months, where the incoming chair will face direct presidential pressure to slash rates by 250 basis points or more despite inflation still running well above target. According to the World Gold Council's research on precious metals during currency debasement cycles, silver typically outperforms gold on a percentage basis when investors lose confidence in fiat currency management. The gold-silver ratio compression we're seeing right now from 104 to 1 down to the 55-64 range is just the beginning of what historically happens during these phases. In every major bull market for precious metals over the past century, that ratio has compressed down toward the 15 to 50 range as silver catches up to gold as initial moves and then accelerates beyond it. Think about your own portfolio for a second. Have you been watching your retirement accounts show decent nominal returns while wondering why everything seems more expensive every time you go to the grocery store or fill up your gas tank? That's currency debasement playing out in real time, and it's only going to accelerate when our new Fed chair takes over in May under direct orders to make our dollars cheaper through aggressive rate cuts. The institutions and family offices managing serious money aren't waiting around to see how this plays out. They're positioning now during this January 2026 window before the velocity phase hits and premiums spike so high that physical becomes effectively unavailable at anything close to spot prices. The evidence isn't subtle if you know where to look. ETF flows, physical dealer premiums, lease rate spikes, mining deficits, Fed chair politics, Supreme Court tariff cases. Every single indicator is pointing toward the same outcome over the next 6 to 12 months. The question you need to answer for yourself isn't whether this analysis makes sense in theory. The question is what you're going to do about it while there's still time to position at reasonable prices. Because once that May transition hits and rate cuts start flowing, trying to chase silver at premiums of 50 to 100% above spot is going to feel a lot different than buying it at 15 to 25% premiums in January 2026. Let me walk you through the specific timeline of what's coming and why the next 5 months represent such a compressed window of opportunity before this market enters its velocity phase. We're not talking about a gradual grind higher that unfolds over years. We're looking at multiple catalysts hitting simultaneously between now and June 2026 that could compress the gold-silver ratio down to levels that put silver at triple digits, while most investors are still debating whether $72 was the top. The Supreme Court tariff ruling expected in January or February is the first domino that could trigger this cascade. According to legal analysts tracking the case, there's a significant probability the court invalidates over $130 billion in duties that our current administration imposed under executive authority. Now think about what happens to the dollar if that ruling comes down and suddenly our trade deficit explodes while our currency loses the artificial support those tariffs were providing. Treasury data shows that even without a court ruling against tariffs, our dollar index has been weakening progressively through late 2025. And any shock that undermines confidence in dollar stability tends to send institutional money flooding into hard assets. Combine that potential January-February court decision with the May Fed chair transition, and you've got a March through June window where every pressure point in the system is converging. Kevin Hassett, assuming he gets the nomination at the 58% odds betting markets are currently pricing, would be taking over the Federal Reserve under explicit orders from President Trump to cut rates to 1%. According to the president's own public statements, this is non-negotiable. He's made clear that monetary easing is the litmus test for his Fed chair pick. Now do the math on what happens to precious metals when our central bank is forced to slash rates by 250 to 275 basis points while inflation is still running at 2.7%. Here's where the gold-silver ratio compression becomes mathematically inevitable rather than just probable. If gold holds its current range around $4,500 and the ratio compresses to 50 to 1, which is actually conservative based on historical bull market phases, that puts silver at $90. If gold continues climbing toward the $5,000 to $5,500 targets that major investment banks are forecasting for late 2026, and the ratio compresses to even 60 to 1, you're looking at silver between $83 and $92. But those calculations assume a normal bull market compression. And what we're facing isn't normal. The short position situation in the silver market is unlike anything we've seen in modern financial history, and most retail investors have no idea how precarious this setup has become. According to Commodity Futures Trading Commission data and bank positions tracked through the Bank for International Settlements, paper shorts in silver futures and derivatives equal approximately 5.5 years of total annual global production. Let me say that again so you understand the magnitude. There are short positions outstanding that would require 5.5 years of every ounce mined worldwide just to close out. And that's assuming nobody else wants to buy silver during those 5 years. Now layer the physical reality over that short position. Available physical float is approaching zero according to dealer reports and vault data from major depositories. When the LBMA needed 54 million ounces airlifted in October just to handle normal delivery stress, that was with vaults supposedly holding 27,000 tons. But here's what that number doesn't tell you. Most of that metal is already allocated, spoken for, committed to industrial contracts, or sitting in ETFs where shareholders aren't selling. The true available float that could actually be delivered against short contracts is a fraction of what the official vault numbers suggest. What happens if just 10% of paper contract holders decide they want physical delivery instead of rolling their positions forward or taking cash settlement? We already got a preview in October 2025 when lease rates spiked above 5% and the system nearly broke. According to money market data from that period, some dealers were paying 6 to 7% to borrow silver for just a few weeks because they had sold metal they didn't actually possess and suddenly faced clients demanding delivery. If 10% of outstanding paper contracts, representing roughly 550 million ounces, suddenly demand physical delivery against a market where the available float is measured in millions, not hundreds of millions, you're looking at emergency premiums that could spike 50 to 100% overnight. The bullion banks holding these short positions know this math better than anyone, which is why we're seeing such aggressive efforts to keep the paper price suppressed even as physical premiums widen. But there's a limit to how long that can work when the Fed chair transition is coming in 4 months, and the new chair is under direct presidential orders to ease monetary policy dramatically. Every time the Fed cuts rates, every time the dollar weakens, every time real yields compress, that metal becomes harder to source physically, and the shorts get squeezed tighter into an impossible position. Now let's talk about price targets, because this is where most mainstream analysts are still drastically underestimating what's mathematically possible over the next 12 months. The conservative analyst community, and I'm talking about respected institutions like Bank of America, Goldman Sachs research divisions, and major commodities trading houses, are forecasting silver at $100 to $150 by year-end 2026. Those projections are based on supply-demand fundamentals, expected Fed policy changes, and modest gold-silver ratio compression. But here's what they're not fully accounting for in those models. In 1980, silver peaked at $50 an ounce during the Hunt brothers squeeze and the inflation crisis of that era. According to official Bureau of Labor Statistics inflation calculators, $50 in 1980 equals over $200 in today's currency when you adjust for 4 decades of dollar debasement. We're already at $72 in January 2026, and we haven't even hit the main catalysts yet. The Fed chair transition, the potential Supreme Court tariff ruling, the acceleration of the physical shortage as industrial demand keeps growing while mining supply stays flat. Historical analysis of every major precious metals bull market over the past century shows that the gold-silver ratio consistently compresses into the 15 to 20 to 1 range during peak phases. According to research from the World Gold Council and Silver Institute examining bull markets from 1979, 1980, 2008, 2011, and 2020, 2021, silver outperforms gold on a percentage basis once the ratio breaks through 50 to 1 and momentum kicks in. If gold reaches the $5,000 level that seems increasingly likely given Fed policy trajectory, and the ratio compresses to just 20 to 1, which has happened in every significant bull cycle, the mathematical target for silver is $250. At a ratio of 15 to 1, which we saw briefly in 2011, you're looking at silver above $300. Are those numbers guaranteed? Of course not. Nothing in markets is guaranteed. But the mathematical logic isn't speculative fantasy. It's based on documented historical patterns, current supply-demand fundamentals that show a 365 million ounce annual deficit, and policy decisions that are already locked in for the next 5 months. The question isn't whether silver can reach those levels, it's whether the timeline plays out over the next year as these catalysts converge, or whether it takes slightly longer if somehow the Fed manages to avoid dramatic easing despite presidential pressure. What should concern you most about this setup is how little time remains before the easy entry window closes. Physical premiums at 15 to 25% above spot might seem high compared to the historical 3 to 8% range. But what happens when those premiums hit 40 or 50% in March or April as the Fed chair transition approaches and institutional buying accelerates? According to Precious Metals, dealers tracking order flow through late 2025, demand from family offices and wealth management firms has already increased dramatically. And those aren't retail investors chasing headlines. Those are people managing serious money who understand what's coming. The $72 silver price that opened 2026 isn't the end of this story, it's barely the middle chapter. Between the Supreme Court tariff case expected in the next 30 to 60 days, the May Fed chair transition with explicit rate cut demands from the president, the ongoing physical shortage where dealers can't source metal, and the 5.5 years of paper short positions that could face a delivery squeeze if even a small percentage of contracts demand physical, every indicator suggests the next 6 months could see price action that makes the past year's rally look like the warm-up act. I'm not telling you to panic or make reckless financial decisions based on fear. What I am telling you is to look at the objective evidence, understand the timeline of events that are already locked in, and make informed choices about how you want to position yourself before this market enters its velocity phase. The analysts forecasting $100 to $150 silver by year-end aren't fringe conspiracy theorists. They're working at major investment banks with research teams analyzing the same data we've covered. The difference is, most of them are still using models that assume normal market conditions, and what we're facing over the next 5 months is anything but normal. You've got a narrow window right now in January 2026 where physical silver is still available at premiums that, while elevated, haven't gone completely vertical the way they will once momentum kicks in. Whether you're looking at this as portfolio insurance against Fed policy mistakes, as a speculation on the gold-silver ratio compression that history says is coming, or simply as a hedge against the dollar debasement that's inevitable when our new Fed chair takes over under orders to slash rates, the mathematical case for positioning now rather than waiting is compelling. The question is whether you're going to act on that information while there's still time, or whether you're going to look back 6 months from now when silver is trading at $120 with 60% premiums and realize you had all the evidence you needed sitting right in front of you in January 2026. If you made it this far, you are the kind of person who actually wants to understand what is coming rather than just react to headlines after it's too late. And honestly, that's exactly who I make these for. Hit that subscribe button if you want more of these deep dives before the crowd figures it out, and drop a like if this connected some dots you hadn't seen before. Stay sharp out there, because the next 5 months are going to separate the people who positioned from the people who panicked.